I thought I actually had shared it, so there we go. I'll wait for a few of you to come in and join me. How's everyone doing? Let me just check, that's all good. Host and panelists, there we go. Thank you, Sam, thank you very much. Hi everybody, hello, hello, I hope you're well. I feel like we haven't spoken in ages. It's been a crazy couple of months. Went to Japan, went to the Tokyo Stock Exchange, went to the Osaka Stock Exchange, amazing. Hi Cecile, hello, hello. Don't know what that is, okay. Okay, so first of all, guys, let's have a look at what's going on in the markets and kind of find out where the moves are happening. There's a couple of things I want to talk about today. I want to show you some big picture stuff and then some kind of small picture stuff. So the first thing that I want to do here is look at the US dollar. The US dollar is the biggest cog in the system, right? It makes up like 60% of the markets. And it's not just in currencies, it's in commodities. Most of the commodities are priced in US dollars. Most stocks are priced in US dollars. So the dollar itself is used in like 90% of all the transactions on the planet, not just within the currency market. Okay, so I want to get a sense of what's going on with the dollar. So the first thing we'll do, let's have a look at euro dollar. Let's actually go to the monthly. This is relatively important because this gives some bigger picture perspective on the monthly as to kind of what's happening. Largely, we can see the euro dollar here is attempting to break through or has broken through a level of resistance. It's working its way up and it's busy playing with the next level of resistance, which is around about 1.16, just above that. If it breaks through that, it's likely that we will see this head up towards 1.9, and it's also possible even beyond that, we could see this go towards 1.22. So this is feasible. It's not completely impossible, but that is at least the direction in which the markets appear to be kind of largely pushing. When we look here on a weekly, we have got an uptrend. We've broken through this level of resistance. We pull back, we've tested that. Now we're going up a little bit higher here, and we're just testing this 1.16 area. And if we go down to the daily, you can actually see we have a nice little uptrend here. We pulled back, tested this level of resistance for support, and the market is currently attempting to move higher. So we at least know the direction in which this is wanting to go. It is sort of encountering a little bit of sort of resistance where it is at the moment. But generally speaking, for now, my expectation is it should ultimately break through this and continue to move a little bit higher. I am just noticing a bit of bearish divergence over there. So that is normally because the speed has changed. So the amount of time the market has taken to move from here to here is a lot longer than it took to go from there to there. So this one, you can see the angle of this almost straight up, fewer candles, whereas this has taken a little bit longer, and therefore it's comparing the speed here to the speed here, and it's falling behind. So that's why it's showing a little bit of bearish divergence. It's essentially saying that the momentum is slowing down, and therefore we could find ourselves going sideways or possibly a change of trend. But generally speaking, I can't really see why the dollar shouldn't continue to weaken. Okay, so that being said, let's go ahead and have a look at some of the other charts. Let's go have a look at GBP against the US dollar. Again, we've got a little bit of a consolidation happening over here, pullback. When we look at it from a weekly perspective, the weekly trend is still very much intact. We've pulled back into the old highs over here. Again, for now, I expect this to continue to weaken. What GBP is really trying to do here is breaking through its level of resistance, which it appears to have done last month. So again, there's less resistance to the upside, and the path of least resistance should see it heading their way. The reason I bring this up is because there haven't been a lot of really big moves in the markets over kind of essentially since April. So March, April, May, and June, right? There's been very little movement in the markets. And a big part of that, if not all of it, is tied to the tariffs. In uncertainty, tariffs, and we can see that it's kind of caused the markets to slow down. So again, let's have a look at Aussie dollar, US dollar. So for example, we can see here during this whole period, the market was actually going down and then up and down and up and down and up and down. Then it tried to break out, then it reversed, and now it's kind of sliding up, and it's also going up and down and up and down and up and down, up and down. And this is a weekly chart, which means that this has been going on for several months. And this is not just against in most of these charts. I mean, it's in pretty much every single one of the crosses, which just shows that the tariffs have impacted all the countries and then have just slowed down sort of movement between them. Kiwi dollar as well here, just up and down and up and down. And you can see this entire period over here. Once you actually include it, it's not just this range over here where it's swinging wildly, but prior to that, there's a move down, then there's a correction, and now we're just stuck back with where we are at the moment. So there's just a lot of, whenever the market attempts to do a big move, it corrects back on itself. Now, guys, I have to say, in all the years I've been doing this, which is going to be 16 years soon, I've never seen this before. I've never seen a sustained period of like confusion in the markets across all the different pairs. It's unusual, and obviously I do think from experience at some point it's going to end. I think at some point we'll get through this and the markets will be moving. But what this does mean is that if any of you have started your journey in the last 6 months, you're potentially going to be thinking this is normal. And what it does is it produces a higher number of losing trades. I've had an astonishingly high number of losing trades during this period. And the main reason for that is that the markets they're not hitting their targets. So when the market starts moving and I take the very first trade in the new direction, it just stalls and then comes back. So the markets are just not hitting their targets. And this is a problem because like we need those trends to kick in. Now, some of the markets are trending. We'll have a look. What I want to do is we're going to do a high level overview of the markets so that we know, like for sure, we can see which ones are not moving and which ones are. So here, one of the things that's interesting about dollar Swissy is dollar Swissy was in a range. It managed to break out of that range. And right now it doesn't really want to come back in the range, but it also doesn't want to go much further. So I think we're seeing a little bit of a slowdown in the dollar just for now. I can't really see the change necessarily being long term. But we might find for the next couple of weeks the dollar goes sideways or there's a bit of a correction. Dollar CAD as well. So dollar CAD here, excuse me, has broken back down below this level of resistance. It didn't find support, and we can see there's a rejection of that as well. So for now, again, my expectation is to see the dollar continue to kind of stay in this area or potentially head lower. So it should continue to weaken. Overall, we do have dollar CAD generally heading higher, but this behavior here kind of implies that it's not really going to change its direction too much just anytime soon. So the bigger picture stuff. So shorter term, yes, it looks as though we might find the price wants to come back up here, test resistance. So we might find this week that we see moves back up to these highs. But again, these trends are they're just not sustained for very long. Then we've got dollar Sing. Let's just have a look at that. Here we can see dollar Sing actually slowing down, but a bullish divergence here creeping in. So I do think, again, here I think we're likely to see a bit of a correction to the upside, potentially breaking through here. We might find resistance. It's possible. This is one of the two outcomes. Alternatively, I expect us to do a bit of a move higher. Okay, so that's built on the fact that we're seeing the dollar slowing down in a whole lot of other charts. And we are seeing some possibility of bullish divergence here, which might lead to a change of trend. Okay, so basically here what's happening is price is overextended. It's come down to a level of support. Looks like it might very well want to come back up and test this level for resistance, for example, and then possibly continue down. So just giving a sense of sort of shorter term expectations here. Dollar yen starting to look more and more bullish. So the yen pairs are of interest to me. The yen pairs are of interest to me here. We're seeing some breaks to the upside on the yen pairs here. They're starting to move a little bit higher. So what we're going to do now is we'll run through all the yen pairs. We're going to look at all the yen pairs because for quite a few of them, they look like they're producing some uptrends. And this could be a good thing. So the yen pairs here, euro yen starting to move a lot higher. Okay, so it just pulled back. There was a nice little bullish formation there, continuing to move a little bit higher there. We've got pound yen, which is starting to test this level of resistance. And I think it's likely to break out to the upside. Okay, so far euro yen, pound yen, dollar yen could be providing some buy opportunities, which is good. That's actually more movement than we've had in the last couple of months. Aussie yen, not so much, and Kiwi yen, not so much at the moment. But still sliding to the upside here. So if we switch this up to a weekly, it's still pushing up a little bit higher, but it's not as bullish as the rest. So I'd kind of exclude those for the time being. Then we've got CAD yen, which is moving higher, by the way. So we've also got an uptrend on CAD yen. And then we've got Swissie yen, which is also moving higher. So on my list of pairs to look for opportunities are definitely the yen charts. They are definitely moving higher. Just not so much with Aussie yen and Kiwi yen. Okay, so excluding those two, I really like the yen crosses. Excuse me, the yen pairs are looking pretty good. And the dollar pairs might provide something, but actually, of all the last couple of months, The biggest moves tend to have happened with the dollar. Now it appears as though it might be some of the yen pairs that are working around that. So now let's run through all the euro pairs. Let's get a sense if there's any strength or weakness with the euro pairs. So let's have a look. Let's just run through them in no particular order. So euro Aussie in an uptrend over here. Euro Kiwi in an uptrend. Okay, so we can see a little bit of bullishness returning to those markets. Let's have a look at Euro CAD. Euro CAD sliding upwards a little bit over here. We'll have a look at all the CAD pairs in a moment. Euro Swissy, nothing really. I mean, it is pushing higher, but it's very choppy, guys. I would stay away from that. And Euro GBP pushing higher. So there's a bit of a sense of bullishness with the Euro pairs. Not bad, not bad. Euro Sing, let's have a look. Euro Sing also trending higher. Okay, so we're definitely seeing, excuse me, a little bit of strength in the Euro there as well. Then let's have a look at the GBP pairs. So let's have a look at Pound Aussie. So Pound Aussie not moving so much at the moment. Pound Kiwi not really moving so much at the moment. Range bound. Pound CAD not really moving so much here, still range bound. And Pound Swissy not really going anywhere just yet. Okay, we've got shorter term downtrend, but it's still stuck within a range. So GBP pairs not as attractive. Euro pairs are looking good. Yen pairs are looking, excuse me, yen pairs are looking attractive. Not bad. Now let's have a look at all the Aussie pairs as well. So let's run through Aussie Kiwi. Not really doing very much at the moment. Okay, largely sideways, sort of straight. Look at this one going down, but then back up, but then down, but then back up, but then down, then sideways. So the problem with that is there's just no sustained trends. Okay, no sustained trends. Aussie CAD, not really offering a lot here either. Okay, Aussie Swissy, not really offering a lot, guys. So the GBP pairs, Aussie pairs, not offering a lot so much. Aussie Sing, absolutely nothing. Absolutely nothing. Completely sideways, not offering anything at all. Now we'll go through the Kiwi pairs. Let's wrap this up. So sort of Kiwi CAD, nothing. Guys, there's no trading opportunities here for now. One day there will be, but just not for now. Okay, Kiwi Swissy, nothing. Is this making sense? Can I check in with you guys? Is this making sense? Yes or no? We're looking at the general flow of price, and we can see that there's a flow of price with some of the charts, but nothing is happening on a few of these, like it's largely sideways. And if the market's not moving, we can't make money on it. Mahesh, thank you very much for replying. So, my point here, guys, is that it's not your imagination. Every now and again, whether you are just a day trader or not, you do need a sense of what's going on in the higher time frame. So every now and again, there's nothing wrong once a week to have a look at the weekly charts or have a look at the monthly charts to see if there is kind of a bigger picture flow of price. We're going to do that actually as an exercise in a moment. So we've run through all the euro pairs, the yen pairs. Let's have a look at the CAD pairs. So what I'm going to do here is run through dollar CAD, see if it's going anywhere. Go back to the daily. Dollar CAD is a little bit bullish at the moment within a sort of a longer term downtrend. So it might be heading higher. Then we've got euro CAD. So let's have a look for Euro CAD, see if there's anything there. So Euro CAD pushing up a little bit higher there. GBP CAD, no, not really offering anything here. So we're getting some mixed results. Aussie CAD, let's have a look. No, nothing here. And Kiwi CAD, nothing. Okay, so there's nothing really happening on the CAD pairs. Sometimes that happens. I mean, sometimes we do get something happening. We're not getting that happening at the moment. All right, so I think we can we can move on from these. But what I'm really going to be focusing on this coming week will be watching to see if euro dollar continues to move high, if that dollar is going to continue to weaken. But we're seeing some signs of possibly it's going to slow down a little bit. The yen pairs to me are the most attractive, followed by some of the euro pairs, which actually means euro yen is an obvious one as well. And so those are the ones to me that are the most attractive. Now let's have a look. I said to you that we were going to do some high level stuff. I want to show you something here. So we're going to look at the monthly. And we're going to zoom out. And one of the things I'd like you to just, there's no way I would have known this, but we're kind of, Chloe and myself and a few guys, we were all starting our journey in this. We were kind of coming in at around about 2010. We were sort of 2009, 2010, we were sort of looking at getting into the game of trading. And back then we used to get very long sustained moves for long periods of time. And then after sort of 2016, 2014, 2015, 2016, the market started doing these kind of weirder sort of range bound behaviors and not really moving as much. And it really used to move a lot more. So if we have a look here, again, you can see big, long, sustained trends, then big moves down, then it started sort of going sort of sideways. And so the currency markets are not really the same as they used to be. But some of them have got downright terrible. So, I mean, this is Aussie dollar, and you can see that Aussie dollar, US dollar used to do a lot of trending, but it's not doing as much now, the last few years. So almost more from 2015, maybe Brexit, that sort of period of time. Have a look at this. Have a look at Euro GBP, so Brexit going sideways. And here you can just see, that's all it's really been doing. And prior to that, we used to have bigger, much more, sort of much longer, more sustained moves. And it really hasn't been doing much. Okay, but there's a possibility that when we do finally, for whatever reason, start moving, we might see that we get some nice long sustained moves after that. Then we have something like Aussie Kiwi. So if you compare Aussie Kiwi, again, guys, to give you some bigger picture stuff here, Aussie Kiwi has done very little, going back to 2013, 2014, around that period of time. But it used to move a lot more. I remember in the first couple of years I was trading that Aussie Kiwi was a really valid end of day chart to trade. We used to trade it all the time. And it would go for 3, 4, 5 days, pull back, keep going. We would do that. Daniel's asking me, do I usually see the daily charts? I do. I do. Gary, can I just check something? You guys can hear me, right? So the sound is fine, right? Let me just check. You can hear me? Okay, just checking. So I do. You've got to get a sense of what's going on in the daily. But all I want to do here, guys, is give you a little bit of a bigger picture look here. So Pound Swissy. Pound Swissy is in an incredibly tight range. This is a monthly chart. This is a monthly chart. And it's got a range of about 300 pips. So that's Aussie Kiwi, Euro GBP, Pound Swissy, and there's a lot of charts that are not really moving, and it takes so long before you really realize that this is something that's taken years to settle in, that it isn't always obvious. It's not always obvious that that not all the charts are worth kind of trading, or if they are, that you should be more aggressive. Like you should definitely be making sure you take some money off the table, or you should be making sure you have a target and you close it out. Because we just, for whatever reason, and I'd love to come back to you and say this is the reason, and I think it's a combination of things. I think it's a combination of global uncertainty. I think it's a combination of where the economies are now versus where they were 15 years ago. I think a lot of those things have sort of changed. And so the money markets aren't really, or at least the currency markets aren't really where things used to be. They used to be, I don't know how many of you have heard of a carry trade. So there used to be something that was very popular back in the day for the big institutions. Let me just show you this one. Let me just get these central bank interest rates. Let's just see if this comes up. So there was a time when the interest rates were quite varied. And so you'd get, for example, you'd get like Japan would have something like 0% or 0.1% interest rate. And then Australia would be like 5 or 6 or 7%. And so what would happen is the big institutions would borrow Japanese yen and sell Australian dollars. So in other words, they're borrowing with very little interest to pay back and lending with very high interest. And so big institutions, hedge funds, mutual funds, pension funds would do that, and banks as well would do that, because it was kind of like easy money. They would basically just earn money on the interest. And then what that did was that actually ended up creating these nice, long, sustained trends, because they would hold these positions for a whole year. And so you got these very nice, long, sustained trends. And then when all the central banks started lowering the interest rates to stimulate the economy, the interest in carry trades seems to have died out. And that was one of the things that would create these nice longer term flows in price. It doesn't really happen anymore. So we'll see. We'll see if it ends up ultimately coming back. But, we missed the stuff just as much as you guys, but I also wanted you guys to be aware of the fact that some of the charts are just not really moving very much, and you need some awareness of that. And although when we look at the monthly, you think, well, I trade the 4 hourly, or I trade the 1 hourly, or I trade the daily, why do I care about the monthly? But although the monthly from left to right is a long period of time, in terms of price, it's a very small distance. We might be talking a 300 or 400 pip range over an entire month, which used to be something you'd get within a week. That's all. So Daniel's asking here, due to smaller moves over the years, do we consider smaller time frames to kill and eat trades? I would say more like that's one possibility, but certainly it means that instead of maybe aiming for 3-to-1 trades, unless that chart is displaying strong trends, we would actually aim for like 1-to-1 trades, or we would bring our targets in a little bit closer. But all I want you to do is have some awareness of what the bigger time frame looks like. If the higher time frame is trending a lot, like look at Swissy yen. So you go to the monthly for Swissy yen, that's been moving. So some of the yen pairs have been providing some of the most incredible trends over the last few years, and they look like they're on the move again. So just something to kind of think about is that means we might end up taking profit sooner, and just being prepared for trends to last a bit shorter. But recognizing that some of the markets will trend, and those are the ones you really want to spend most of your time and effort. Okay, cool. Next up, let's have a look at crude oil. So let's have a look at crude oil. And so bigger picture crude oil, we can actually see that it's generally been going a little bit lower. So now, of course, bizarrely, we've got some wars breaking out and various other things. So there's a bit of a spike in oil. I don't have evidence to support this. I'm not convinced that oil is going to necessarily go up to the prices it was, because I think that slowly but surely we are reducing our dependence on oil. Obviously, it's not just used in cars, it's used in keeping your houses warm in winter, it's used in shipping and rail and various other things where oil is also used, for various other reasons. So there is a bit of a surge in it, but I'm not completely buying that this is a limited resource and that, we need it to survive. So I don't really know if this is something that will continue to rise. We'll see. But shorter term trading again, shorter term trading. So we've seen a complete break of this move to the downside. We're back above the levels. So shorter term guys, I would start looking for those kind of buying opportunities on this. It's not the best chart that I've seen. When you look at the bigger picture, it's a little bit all over the place. It used to be something that was worth trading. You could get some really nice trends in it, but not so much anymore. Again, this is something that we all feel. Now, let's have a look at gold. So gold, now this is an interesting one because gold has a potential trade. Exactly, concern you that crude oil could just go all over the place. So again, with those types of things, you might see shorter term patterns and just that's it. Take the money and run. So gold technically is in an uptrend, right? So we've got higher lows, higher highs. We've got prices pull back to the moving averages, potential area of support. In addition, it doesn't look like it, but the MACD is also playing ball. So we actually have the MACDs trending a little bit higher. So this looks good to me as a possible actual buying opportunity where we are right now. So the way in which I would do that, potentially entry above the high of Friday's candle, stop loss below the low. Here's the concern. So here's the red flag with this, but it is right now an actual potential trading opportunity, is that I suspect we do have some resistance at this 3431 level. And if we can get through that, probably 3,500. So we've probably got 3,500 here. But the truth is gold is in an uptrend and I think it's going to take another run at the highs, but I just want to be very careful that where we are is a potential bit of a danger zone. If we have a look at the weekly, we haven't really connected with the 20 period moving average in a while. The MACD is very healthy. So what it's telling me here is that, any kind of a pullback here could ultimately represent another buying opportunity. So that looks okay, but you can see there's a difference in the price action here. Look at the difference in price here versus anywhere else. The last time we see this up and down is sort of when you get to an area like this or an area like that. There's clearly a battle going on. So what is the battle? The battle is that there's a number of different parties in the market right now. There's people who are buying gold every time it drops because they think it's going to keep going, or they think that it's not going to be cheap for a while. So every time it drops, they buy, which keeps pushing it back up. But then there's people taking profit as well because they want to get out of their positions because they think it's due for a bit of a correction. And then you get people who are selling it because by their very nature, they think it's oversold that it's overvalued and they need to kind of bring it back down. So you've got this battle going on between bulls and bears and shorter term positions and longer term positions, which is just creating this bigger move over here. I do think we're in a bubble with gold. My logic for this, I've said in the past, is that the sustained move we've had here is the longest move I've ever witnessed in my life without a real correction from a monthly perspective. I think, and therefore it's created a bit of mania. The thing about bubbles is that you don't know when they're going to burst. You could take a very sort of brave approach, but hopefully sensible approach, where I'm going to trade this bubble until it bursts. So I'll make sure every trade has a stop loss. I'll make sure I take profit. And so you're trading it because you're aware that at some point it could be a year from now, but at some point it's obviously going to have a bit of a correction. And so you definitely, if you're doing that, you absolutely have a stop loss in place because you don't want to get caught in this. If it does have a correction and you decide, oh, gold has to go up, it has to go up, and then it just drops 1,000 points and blows your account. That's the kind of thing that would happen with someone who hasn't been trained. So you guys have been trained, you're surrounded by experienced traders, and I'm telling you now that this isn't a bubble and it could keep pushing up, but eventually when it does drop, it's going to tank, and you don't want to be caught on the wrong side of that. And the thing is that that's actually very difficult to predict. You'd have to watch it on a much more closer basis. So from a monthly perspective, we're very overextended, and you can see it running into a little bit of headwinds over here. But the way that it did that in the past is here, it just consolidated and then it just carried on. And that's what it's doing now, believe it or not. It's just consolidating, it's just treading water. So it could continue to do that, and then it could continue to go higher. But these are the key levels. I'm watching the key lows over here. If we break that, we could see a bit of a correction down towards here. And the only other thing that's interesting, but doesn't necessarily mean anything, is that this was $1,000 an ounce. Not there, sorry, $1,000 an ounce. And actually, just before I started becoming a trader myself, started my journey, we'd actually broken through that. And that was around the 2008, 2009 global financial crisis. Gold obviously became a form of security there, so the market broke through this key level. Came back, touched it, so very briefly, came back and touched the highs, and then actually proceeded to go into a bubble. So I kind of got into the game just about 1,100 here. April 2010, I think, was the first time I officially attended a Forex course. And the market continued up until 2011, and then it bobbed around until 2013, where it then broke through this. Now, this is where it gets interesting. It basically essentially came all the way back to that level to touch that. Within about 30, 40 points, it corrected almost all the way back to $1,000. Went almost to 1,200, sorry, to almost 2,000. So went from 1,000 to almost 2,000 and came back to almost 1,000. So the only reason I'm telling you this is that back then, at the height of the bubble then, which was very similar to what I'm hearing now, people are saying there's no way gold's going to come back down. And it did. And then nobody cared about it till 2019, where it broke out. So I'm just letting you know that is it possible that at some point in the future, gold could come back down to test 2,000 as support? It's possible. It's possible. It's done a big correction, but that could take several years. It could be something that it does over the next, over several years. I just want to put the idea in your head, because it's happened in the past. I want to put the idea in your head that is as impossible as that might seem right now. If it took 5 or 6 years for gold to lose its shine, in 5 or 6 years' time, you wouldn't be thinking it was so impossible, because by that time you've got used to the idea that gold could lose value. So all we really need is enough time to be exposed to something before we change our opinion. Okay, so I just want to put that in your head so that you've got that. Next up, silver. So if you compare gold and silver, gold is generally better to trade. Just even here from a daily perspective, if you compare it, this is silver. It's a lot more choppy. It's a lot more volatile. So it's not as pleasant to trade. You're much more likely to get stopped out, triggered in, stopped out. You're much more likely to. But when it does trend, you want to get on it. So it's not something that I don't want you guys to think that silver offers opportunities as often as gold does, because it doesn't. But there are times when it starts trending, and when it does, which could be once a year or something, then you want to maybe potentially get in on that. By its very nature, it's choppy and relatively volatile. Gold is more attractive for trading purposes. All right. So that takes us through all of those. Let's have a look at the global indices, and let's start off with the Dow. The Dow is the oldest one, so we're having a look at that. First of all, the Dow is 1896, and that's 30 companies. They haven't always been the same 30 companies. They've bumped ones and added ones over time. Quite a few of the original 30 have closed down, have expired. They're not in existence anymore. So it doesn't always mean that every company that gets listed is never going to fail. So what I want to draw your attention to here is just the angle that price is just generally running at a lot higher and a lot hotter, and that there's more choppiness. Look how nice and smooth this is, that it gets choppy, and it's choppy over here, and it's a lot choppier. It's connected. The very fact that it's running more aggressively means the swings are wilder, the weekly ranges are a lot bigger. It's just something to be aware of. It's part of the nature of the beast. Okay. I still think though that generally speaking, the indices offer the best trends year in and year out. We have pulled back. We had a bit of a correction here. Price did come back in to test the highs here, and the market appears to be getting ready to attempt to push higher. So this is a very interesting topic, and I want to kind of tell you a story here because we hear a lot in the news that makes it hard to imagine why the markets could. There's a lot of very bearish stuff in the news, which makes us think like tariffs and various other things could impact the US economy. And if it's going to impact the US economy, we could see the markets kind of drop. So there's people who are bullish on the markets and people who are bearish on the markets. And I'm going to present a case to you guys. So first of all, one of the stories that always sticks in my mind was that Warren Buffett and Charlie Munger, their favorite kind of a stock was a stock that had all the right fundamental boxes ticked. But then the company would run into some kind of a PR problem, some sort of very easily fixable problem that was blown out of proportion in the media, and it would impact the stock price. So then people would sell or it would impact it. And then the problem, they would buy the stock, and then the problem would just get fixed and move away. And then the popularity of the stock would go back. And so they managed to get it at a discount because essentially there was this temporary problem that wasn't a real problem that could be fixed. So I was thinking about this because I was thinking, the tariffs seem like a real problem and don't see how the market can get around this. And the market was responding in a relatively bullish fashion. And it's occurred to me that the market could be seeing the tariffs as a easily fixable problem because they didn't have to be imposed. They were completely manufactured. They didn't have to be. The market was doing fine before that. This is a hypothetical, guys. And so suddenly we create this problem of the tariffs, which causes the market to kind of tank. It becomes very attractive. None of the real fundamentals have potentially changed. And then the market just kind of picks up from that. Now, that's just one explanation as to why the market would have had a recovery like that. It's just a potential explanation for that. There are other tools that they can use to juice the markets. They can use printing, so they can print money. They can offer loans. They can cut rates. So there's a whole lot of things they can do that will effectively kind of juice the markets. And the only other thing that I thought I would add in here is that there are periods in time when the uber wealthy own a larger percentage of the markets historically, and it happened in 1929 as well. There's this period in time when the upper 1%, for example, will own like 60 or 70% of the stock market. So when you're seeing the stock market move, what you're really seeing mostly there, not all of it, but mostly, is big money. You're seeing this is not middle class. It's like the top 1% money going into the markets. And so for them, they're obviously looking to buy every time there's a bit of a dip. They've got plenty of cash, so there's no reason why they can't just keep buying. And so that is one possible explanation for why you keep seeing the market continue to push higher, even if you're not really entirely sure that it's sustainable. All right, so it's sustainable. Now, so that would be that's the bulls. I'm just giving you an example of where the bulls might have optimism. They might see, listen, this isn't the economy being reflected in the index. This is just money being reflected. So this is just money that's buying stocks at a discount, and therefore it's not tied to the economy. Plus, they might want to push and cut rates, and they might want to continue to do stuff and create situations that, create money-making opportunities in the market. And those are all very real. There's some weight to each of those things. It's not completely ridiculous. It's not a conspiracy theory. There's some possibility that could be cumulatively creating a drive in the market. Then, the case for the bear market. So then the case for the bear market is that the tariffs are going to have a real impact. So what is we're running over by about 5 minutes, guys, but the logic behind tariffs, so let me explain that it's not, these are not the first time they've happened. The general idea behind tariffs is to encourage manufacturing at home. It's like when a new CEO takes over a company, the first thing they do is look to cut costs, right? So then they look around, they go, why are we outsourcing? Why are we paying these suppliers for stuff that we could do it ourselves? So they kill all their contracts with all their suppliers. It's the same thing. So the logic here is to encourage growth and to redirect money to doing those kinds of services and things internally. But the smart way to do it would be to take a few years to do it, to say, listen, over the next few years, we're going to raise tariffs. We want to redirect. We're going to invest money in infrastructure. We're going to invest money. If you want to build a company that does this, we'll provide education. We'll invest the skills. We'll do all these various things, so that eventually we can redirect all of that stuff internally. Because it's not just the physical stuff that America doesn't have. They don't have the skills, because those skills have been developed overseas. And so all these services and skills and materials and things are all in other countries that America doesn't have. And just by doing this, the other thing is which company inside America, or who's going to want to build a company, manufacturing company, if those tariffs might just get dropped in 6 months' time, because it's like a roller coaster ride. So in other words, nothing's going to happen. It's just paralyzing the markets. So from a bear's perspective, if you're going to be bearish about the market, it's going to be, look, we're going to see an increase in job losses. We're going to see a reduction in growth because no one's going to invest in it and they're not redirecting the money there. We're going to see a rate in tax hikes, and we're going to see support taken away for the bottom percent. And those are the people that are going to be losing their jobs. We're also going to see AI take away jobs. And so the bears are arguing that there's just no way around this, that the US economy is going to take a hit. And if the US economy and the US becomes very unstable, the dollar is going to become unattractive and US bonds are going to become unattractive to hold. And so there's this argument that we are at the beginning of the end for the US, and that over the next 5 to 10 years, we could see this just movement away from the US and starting to do trade with other countries and essentially look for stability. And now, of course, to top it all off, literally the US decided to start a war last night. In the last 24 hours, has decided to go to war. Which also makes no sense. There's just, anyway, so like it's just a mishmash of just noise at the moment. So I just wanted to kind of present to you guys that it's interesting because sometimes I'm just trying to explain why some people could see things one way and other people could see it another way, and just trying to present it. But what our job is to do is to not really try to conclude what has to happen. Our job is to kind of see which way the market is ultimately responding and then adjust to that. So starting with the Dow, here's what I also wanted to show you. This is known as a V-shaped recovery. So in the markets, this is known as a V-shaped recovery. It's usually, if it is a true V-shaped recovery, it's a bounce. It's then followed by a bull run. And this is a weekly chart, so there could be a bull run for a while. And the bulls are saying this is a V-shaped recovery, and therefore the possibility of a bull run after this is actually possible. It could happen for whatever reason. They could cut rates, they could stimulate cash, they could put money, they could do it. So I'm putting that idea in your head. I'm not saying it's going to happen. I'm saying that if it did happen, if your brain is like, there's no way this can happen, the markets have to tank, I'm saying actually not necessarily. Because one of our biggest frustrations in life comes from trying to reconcile what we think the market should be doing versus what it is doing. That's why people lose money, because that's why technical analysis is so good, because we don't focus on what we think the market should be doing, we just focus on what it is doing. Okay, is everyone with me? Yes or no, this makes sense? Yes or no? So the bulls see this as a V-shaped recovery, and they see this as a V-shaped recovery. But the bears see this as something like this. They're seeing the fact that this is the first drop below the 50-period moving average, which was still in that area, and therefore that what we're likely to do is to see them going into another bear market. So there's another thing potentially looming its ugly head in the US is inflation. And the invasion of Ukraine and global inflation is what triggered this move. So it's possible that if the Fed decides not to cut rates, that something similar to this could happen. So I'm presenting you with both things to say that, look, there's a reason how both things could happen. And that's why where we are right now is a bit of a messy place to be because of that. So if we have a look at the S&P, and the S&P is a really good sample. It's 500 companies, guys. 500 companies from around the world. We know all the brands. And so if there's going to be a global contraction or there's going to be issues, these companies will potentially feel the pain, right? So we're also back up here at all-time highs. And therefore we could find some resistance. So unfortunately and annoyingly, this is a weekly chart. So we're going to have to kind of keep an eye on this. But also it appears to be diverging. So we've got some divergence here. We've got highs running out of steam. And so we could potentially see this starting to head low. We could see that. We could see it actually, what could happen is that generally if you're above the 50 period here, you're generally bullish. So there is a possibility we could come down to the 50 period here and then bounce and then start our way back up. Okay, so the weekly hasn't really had a retracement. So there really is look, there's not an unlimited number of ways this could play out, but there's at least one or two. We could see the market drop now, which the bears will see as the next big thing crashing, but then it could find support on the 50 as it does. Okay, so notice how here, guys, over here, we drop below the 50, then we come back up and we find support above it. Then we get underneath it and we get stuck underneath it, but then here we bounce back up above it. So that's what we're really looking at. Are we going to go back under it here and get stuck under it, or are we going to bounce and work our way up? And that's what I would like you to keep an eye on. So for the weekly, I want you to keep an eye on how price comes into this area and potentially find support. So these are areas that I would think we should test for support. And again, if I'm taking trades to the downside, very cautiously, always taking profit ahead of key levels, guys. You gotta watch out for those key levels and keep an eye on those things, because if they are going to bounce, they'll do it in minutes. They won't even just do it over days. They'll bounce immediately within minutes. And again, I'm just trying to give you an option here as to why we might do a drop and then just recover. So it'll feel like the market is swishing around, but from a weekly perspective, it's just a retracement and a bounce back up. So just be prepared. All I'm trying to do here is we're doing a trading plan. We're creating like, this is how things could play out. And eventually what will happen is, eventually it will settle into what's happening. So right now it's in one of those weird places where it doesn't really know what it wants to do. But eventually if it does, for example, start dropping, we'll see it accelerate to the downside, because then people will start to panic. And then all of a sudden, we'll see more people start to short the markets. And if it starts to correct to the upside, unfortunately, because the news is predominantly bearish, it'll be very hard for people to accept that the market is continuing up to new highs. But I'm trying to explain to you guys, it could very well happen for very simple reasons. Big money going into the markets, rate cuts, various other things, and that this isn't necessarily reflective of the economy. Okay, it's just rich people's money, followed by institutions' money. Pension funds, like mutual funds, are not allowed. Pension funds are not allowed to sell positions. They can't short the market. So pension funds will be buying as long as the market looks like it's bullish. They can't sell. Pension hedge funds, that's what makes hedge funds so different, is they with the ability to short the market. So just understand that a lot of big money that holds its positions for long periods of time cannot easily get out of those positions. They can't really do that. So there's always more money going into the market than going out of it, which means that its bias is to go to the upside. That's just basic mechanics. All right, so let's look at the NASDAQ. So the NASDAQ is back up here at highs. Let's keep an eye at that. So this is a key level to have a look at. Again, a drop down here into this area, finding support and keep going up, very possible. I know where we are. That was a really ridiculously quick bounce. And again, it might be the beginning of the end. It's very possible we could be seeing something similar to what happened in 2007, which was, let's actually have a look at that, S&P, which is over here where we really started to go. Actually, where is it? There it is. I beg your pardon. So, we could be very much at the very last bounce before we go to that. I'm just saying, but this is a typical V-shaped recovery. Like, it really is. And therefore, the possibility of a bull market could still continue for a while. Let's see. Just keep it in your mind. As crazy as it is. We've got the UK up here, potentially FTSE, possibly double topping. Another couple of minutes, guys, and then we're done. So again, I think there's a possibility in the coming days or weeks maybe to see just a move lower, but not necessarily significant, just a move lower. The DAX, okay, guys, is definitely obviously coming back into these highs. This has been one of the most bullish markets outside. Is the most bullish market outside the US. Some bearish divergence, so also a bit of a bounce. Let's see what happens there. We've got EU stocks, again, a lower high, but that doesn't necessarily mean anything just yet. The Nikkei actually holding up relatively well. The HK50 to me is holding up relatively well. It's taken a while to get above here, but again, I see sort of more buying opportunities. So again, we could be working our way to a bit of a breakout. ASX, let's have a look at that. So we're all in areas now where I think it's very likely we'll see at least a couple of weeks to the downside, but not part of the bigger picture. Just take it as a shorter term thing, and then let's see how things play out. And then again here, the China one also again trying to find support and move back to the upside. So I'm going to leave you with that. We live in interesting times. We've got to think shorter term. So think a few days at a time rather than necessarily a few weeks. I think the yen pairs offer some of the best opportunities for now. Possibly the dollar could, on the majors, could provide some of that. Gold is something worth having a look at. And then with the indices, just accept that it's going to be a bit wishy-washy for a bit. But yeah, if we see it heading lower this week or something, start to break those lows, then let's see. Really keep an eye on those key levels, because that's where it'll work its way down to. And then we'll get some possible bounces. But you can kind of see what it's battling with at the moment, and you can sort of see where it's going to go. That's it. Any questions, guys? Any questions? Okay, good. Did you enjoy that? Good. Good. Cool. All right, guys, absolute pleasure. I will speak to my guys in the trader zone as well. just because of all the traveling and stuff, it hasn't been as busy as normal, but let's have a look at that. Excuse me, throat's itchy. Sam, as always, thank you very much, guys. I'm going to let you go, and I will speak to you guys soon. All right.